Okay, so you can't retire confidently until you know your three numbers: your income gap, your freedom number, and your tax drag. These numbers are the difference between living fully and living tepidly for the rest of your life. If you skip the math, you will keep second guessing every trip, every gift, and this isn't the time for second guessing. You should have the freedom to choose what you want because that is the reward for your decades of work. Hi, I'm Jason. I build retirement plans every week. And today we're going to cover the things that really matter. We're going to start with your income because checks pay bills. Next, we're going to confirm the size of your nest egg because that nest egg is what fuels your income. And lastly, we're going to plug the tax leaks and send the IRS as little as legally possible. Let's kick things off with the income gap and first defining it. What is the income gap? The income gap is the difference between what you spend and what you have coming in that is guaranteed income. Okay, so what we typically see with people is that their spending is more than their guaranteed income. All right. They're not able to make sure that they have enough income coming in every month strictly through guaranteed income. That's the income gap. So, in terms of guaranteed income, some examples are Social Security, if you have a pension, if you have an annuity that's been annuitized and you have a guaranteed lifetime or monthly income payment coming in, that's our guaranteed income. So, let's just say for this couple in this example, they have $6,000 of spending and they have $3,000 of guaranteed income. Well, that means that their income gap is $3,000. Okay, so we're focusing on the income gap, but I want to make a point about spending. And this is because a lot of people have a general understanding of their spending, okay, in the various parts of life that we just need to spend money to live, whether that is our utilities at our house, gas in our car, food on our table, doctor's appointments, medicines, all those types of things. But there are some that are often overlooked or people misestimate what they're actually spending. And one of those first things is healthcare spending. Next, we want to really understand how much we are spending in terms of variable expenses. And when I say variable expenses, what I'm referring to here are the fun things, the travel things, the little things that are above and beyond, not necessarily the need to have, but the nice to have. And then lastly, I want to hit on inflation because things cost more than they did a year ago, 3 years ago, 5 years ago, and they're going to cost more in the future than they do today. So we want to have an understanding of what things actually cost now, especially after the last couple of years when we've experienced higher than normal inflation. So now that we understand what the income gap is, and in this example, it's about $3,000, we want to ask, where are we going to get this $3,000 a month from? And we're going to go to our investments. And in our firm, we build our portfolios based on the financial house. Okay. There's a roof. Those are your aggressive investments. Think stocks. Then you have your walls. Those are your more moderate investments. Think bonds. And then you have your foundation, which are your safe investments. Okay. And in general, it makes a lot of sense. And there's a lot of research out there that if we're going to take income, all right, if we're going to get this income gap from some part of our portfolio, we should go ahead and go first to the foundation. Why do we want to pull this income gap number from the foundation? Well, number one is if we pull it from the foundation, we don't have to worry about locking in losses. Number two, we want to pull it from the foundation because foundation investments are our safest investments and they're also our lowest return or lowest yielding investments, right? Stocks and bonds have more potential return than our foundation. So let's pull our income from the foundation. And this isn't an idea that we came up with. This is actually something called LDI or liability driven investing. Okay. And LDI is used by pension funds, endowments, foundations. And basically, what they do is they say, hey, if we have some liability, just say we have to pay a pensioner their pension. Okay. Or if we need to pay our income gap, we're going to take it from the foundation investments. We're going to take it from our safest or lowest yielding investments. And so that's great. We want to steal the tips and the tricks and the strategies from the big guys, from, say, the pension funds. And what this allows you to do is you have investments also in the roof, and in the walls. Well, those have more potential for growth, and we want them to grow. By taking our income gap number from the foundation, it allows the roof and the walls to kind of continue to bake, continue to grow. And we want that to happen. Actually, we need that to happen. Number one, for inflation. Our roof and our walls, those investments that have the highest potential for growth, those are our inflation hedge. Those are going to grow our nest egg so that we can continue to buy those things to keep our standard of living. Not to mention, if our roof and our walls grow, it can actually mean extra money for fun, for travel, for blessing people, or donating to charities. And lastly, it really helps in terms of the longevity of our plan. If we're able to not touch our roof and our walls that much and allow them to grow, it can really stretch out our dollars so we don't have to worry so much about running out of money. Okay, so next let's cover your freedom number, which is what is the size of the nest egg that we will need to fuel our income gap. All right. So in this example, it's $3,000 a month or $36,000 a year. All right, I'm going to share with you guys two simple formulas, and these are not end all be all formulas. They will not get you to some magical number, but we can start to get in the ballpark of what is the nest egg that we need? What is the freedom number that we need to sustain the income that we want in retirement? So let's just say to get $36,000, we're going to use the 4% rule. Okay. And we're going to say, hey, what if we just pulled out 4% from our portfolio to be able to fuel our income gap number? What does that portfolio size need to be? In this simple example, if we take $36,000 and divide by 0.04 or 4%, we have $900,000. Okay. So some people might say, oh, I need $900,000. That's my nest egg goal. Let's go ahead and call it a day. And I really want to caution you from doing that. There's several more steps that we want to go through. So let's cover a couple of those. Now, first of all, we didn't really talk about taxes, okay? Because most people, whenever they're doing their income gap number, they say, I need $3,000. They're typically thinking of net. I need $3,000 net into my bank account every month so that I can just go ahead and spend that, okay? They're not thinking, I need 3,000 and then when I take out taxes, I'm going to end up with 2,700 or something like that. No, this is an after tax number, a net number. So we need to gross up this number to make sure that we took out enough to pay for taxes and we can still end up with $3,000 a month. So let's just say in this example, this couple is in the 15% tax bracket. So now we've grossed up that annual number of what we need. We said, hey, if we are in the 15% tax bracket and we want to net $36,000, we actually need about 42,000. I rounded this number down. Okay. So what you can do if you want to do that math, you divide 36,000 by 1 minus your tax rate. So in this scenario, 1 minus the tax rate is 0.85. So I divided 36,000 by 0.85, and that got me to 42,000. Okay, so now we have grossed up our annual number, all right, to account for taxes. So how does that translate into the size of the nest egg that we need? So in this very simple high level example, you can see if we go ahead and gross up our annual number, and then we still say we want a 4% withdrawal rate, go ahead and add that in there. That brings us to $1,050,000. Okay. Again, we haven't ended up at the place where we can feel super confident about this number. Why? Because we haven't run this through a couple of more steps. And I'm not going to be able to go through all of those today, but I just want to share them with you. Okay. Number one, we need to be able to account for inflation, right? If you hope to live 20, 25, 30 years in retirement, you're not going to need $42,000 every year. Every year, that's going to need to get to be a little bit more, right? So that you can keep up with the rising cost of goods and services. Next, we want to put this number through a stress test. So just like you go to the cardiologist and you have a stress test done on your heart, we want to have a stress test done on our nest egg. Is this number real? Through up markets, through down markets, like I said, in taking in consideration inflation, not to mention what happens if interest rates change. We've been going through a lot of changes with interest rates over the last couple of years. How does that affect our number? And then lastly, we really want to be using something like a Monte Carlo analysis where we can use very complex algorithms and softwares to test this number so that we can feel confident about our freedom number. So as you can see, there's a lot of planning involved in terms of the income gap and the freedom number. And if you're watching this video, you value planning. And if you own something and you love someone, you want to have your affairs in order. And that's why I want to invite you to click the link below where you can download a free copy of our retiree estate organizer. All right. On the first page, there's 3 easy steps. Okay. Shows you how to get everything in one place. Number two, it shows you how to write down which companies you're going to need to call, okay, and the things to ask. And number three, it gives you the exact script of what to request and what to say. Now, if you want to dig deeper, there's much more to the guide, but that first page helps you to really jumpstart and get things in order. So I want to invite you to click the link below, and we'd love to send you a free copy of that retiree estate organizer. So now we're going to end with tax drag, okay? Like I said, we want to plug those tax leaks to make sure that we're sending the IRS as little as legally possible. Okay. So one of the first things that I see, one of the first mistakes that I see amongst retirees and other advisors just missing things is where are you putting your assets? Okay. You have different accounts. You have an IRA over here, a joint account with your wife, your Roth. And we want to say, okay, which asset goes in each of these tax buckets? So I want to start with tax deferred. Tax deferred are those accounts like your 401k, your IRA, your deferred comp plan. Maybe it's called a 403b or a 457. These are all tax deferred accounts. They're retirement accounts. They're accounts that have been growing, and you have not paid any taxes on them. First, when we're investing our assets to reduce our tax drag, we want to be very intentional about which assets we put in which bucket. So, what are some good examples of things that you may want to put into the tax deferred bucket? Well, the first one is bonds because bonds give you interest, all right? And so, if we don't put it in the tax deferred bucket, that interest every year is going to make its way onto our 1040. It's going to become taxable income. Another example of something that you may want to put into a tax deferred bucket are those funds that are more tactical or have a lot of turnover. So if you have any mutual funds or if you have any models that do a lot of trading, you'll probably want to consider putting those in the tax deferred account because you can end up realizing a lot of short-term and long-term capital gains. And so those stay tax deferred. So then you're not really surprised by all this movement of money that's happening. You get to decide when I pull money out of the tax deferred bucket so that you can understand what your tax rate's going to be. Next, I want to jump to the tax-free bucket. And tax-free bucket is the most coveted bucket in all of retirement. And typically when we're talking about tax-free, we're talking about a Roth account. And so with the tax-free bucket, as long as certain guidelines are met, you can put money in, it can grow and grow and grow. You don't have to pay taxes on that growth or any interest or dividends you receive along the way. And then when you pull money out, it's tax-free. So, what are some good assets that we want to consider to put in the tax-free bucket? Those are all of our high growth investments. And the reason we want to put our high growth investments in this is we want to grow the bucket of ours that we get to kick the IRS out of, right? I don't want to really be very aggressive in my tax deferred bucket because I'm growing a bucket that I end up having to pay a portion to the federal government. I would rather these types of investments be in my tax deferred bucket and then my high growth investments, those are in my tax free bucket like a Roth. So I grow that as much as humanly possible because whenever I pull out, I don't have to pay the IRS. And then lastly, we have the taxable bucket. What is the taxable bucket? Well, the taxable bucket is money that we've already paid taxes on, and then we invest it. And then if it grows, we have to pay money on those gains. We also, whenever we invest that money, if we're getting dividends or interest, that money is going to make its way to our 1040, to our tax return. We're going to have to pay taxes year to year in terms of a taxable account. What are some examples of a taxable account? Well, that could be an individual account that you have at your brokerage or your investment firm. It could be a joint account that you have with your husband or wife. Maybe it's a trust account. Okay, so what are some examples of things that we want to consider putting into the taxable bucket? Well, we'll want to consider putting things like index funds or ETFs, those types of investments that have low turnover. What do I mean by low turnover? I mean, there's not a ton of buying and of selling that goes on. So we're not creating all of these taxable events, all right? And typically, most index funds that I'm referring to here, we want the ones that are not geared more toward income. They're geared a little bit more toward just in terms of long-term growth. I'm running out of board space here, but I have one last concept or one last tip that I want to share with you in terms of tax drag, and that revolves around mutual funds. You see, with mutual funds are basically a basket, okay? They're a basket of stocks or bonds or other types of investments. And they were very, very popular. They kind of came out and became popular in the 70s and 80s. But I want to caution retirees from using mutual funds because mutual funds can really increase your tax liability. They don't take tax drag into consideration. I'm sorry, they don't reduce tax drag. And what do I mean by that? Well, a mutual fund can end up giving you something called phantom income, meaning you own the mutual fund, but you didn't own the mutual fund whenever a gain was realized or whenever a distribution actually came out, but then you get taxed on it. Okay. So that's really, really bad. Another thing that you want to be careful of is with mutual funds at the end of the year, they typically push gains down to the mutual fund holders. So if you end up owning a mutual fund, especially in a taxable account, you didn't make any choice to buy or sell anything, but then you're going to get those gains. And so you can get surprised by a tax bill. And being surprised by a tax bill can really have a waterfall effect. So if we're trying to keep our tax drag low, if we're trying to send the federal government, the IRS, as little as legally possible, we want to be very careful in terms of mutual funds. All right, so I hope that this was helpful to cover these three critical numbers so that you can understand how much do you actually need to retire. And I want to invite you to click this video here where I go over the four financial planning mistakes that are draining your retirement fund.